So strategic tax planning can help in protecting business and personal assets because we have a saying here, it's not what you make, it's what you keep. What that means is you can have a really good commercial outcome, but if you've been set up in a tax structure that's ineffective, you may lose 50% of what you made in that transaction, as opposed to somewhere between 0 and 20% in a better structure than what you would otherwise be in. So if you're talking about a transaction of a material nature, millions of dollars, like losing 50% of that, particularly I find when it's clients are selling their business, they've worked in it for many, many years, and this is their retirement event, they want to maximise what they keep at the end of that for their retirement. I'm Glenn Harris, I'm a director at Bishop Collins. I've been at Bishop Collins since 2013 and I focus on supporting the team and clients with taxation affairs, including small medium business, restructuring and also international tax affairs. Yeah, the way we deal with asset protection, so how I would describe it for our client base is ensuring that if an unexpected risk comes up or an event, which they typically are unexpected in a small business because small business clients are focusing on delivering outcomes for their clients and building their business, not so much ongoing risk assessment, which a larger organisation may have a team of people to do that. It's really important that they understand that if that does come up, that protection's already in place and how they're going to respond to it. Yeah, asset protection is really important. Now, who should consider it? Definitely small business to medium-sized business operators should consider asset protection. It's important that they separate their business operations from their wealth creation because we never quite know what's going to come up in a business. Ongoing risk assessment's really important. So just considering that once your business gets to a certain size is really important. So the choice of business structure can significantly impact asset protection and the tax outcomes. Common structures for smaller businesses may include a trust or a company or even a partnership or a sole trader at the small end. So each of those has its own risks and its own costs. In regards to asset protection, if you're a sole trader, well, clearly any assets that sole trader owns are open to creditors to claim against. And in a company, you've got corporate protection there. You can always put a company into liquidation and protect personal assets subject to a variety of things in the corporations law that do provide access directly to directors. In regards to tax, we look at companies sort of as the starting point for any new business because what that allows for is the tax to be capped at 25% corporate rate, and you can keep that cash in there, reinvest, grow your business without any additional tax liabilities. There's a few benefits and drawbacks in using trusts in asset protection. Trust law, to start with, is unusually complex, and when it comes to the interaction of trusts and the Income Tax Assessment Act, there's a lot of complexities there. The issue is the documentation needs to be accurate, your distribution minutes. There's a lot of things that trustees may get wrong and that may have adverse tax implications. You've also got a trustee that needs to be followed whenever you operate the business and make sure your distributions from that trust are in line with that trustee. So there's another layer of documentation you need to comply with as opposed to a company. In a company, it's relatively straightforward. You can maintain those profits in there and reinvest them and grow the business. So what structure should you consider for your business? You would need to consider both the long-term capital gains tax implications if you ever sell the business, but also asset protection. We can achieve outcomes where it's not a binary either or. You can actually set up a structure depending on what you're doing, which achieves great asset protection and also really good tax outcomes at the end. So there's tax outcomes as the business grows and what the tax you pay on those profits and if those profits are distributed to the owners of that business. And then you've got capital gains tax should you sell that business, should you retire or move on to something else. So you can certainly select a structure which achieves good outcomes for both. And that will really depend on the size of your business and the parties involved in that business. And and what that would look like, not only now, but in the future. I believe business owners should take the time annually to do a risk assessment in regards to their business assets, but it's not only the assets itself, it's the operational issues. I think it's worthwhile consulting with a variety of people who work in different spaces. Now that may be tax, it may be work health and safety, and compliance with whatever industry you work in, whether it's food or safety, and make sure that what your business is doing is compliant with all of those requirements, legislative or otherwise, because you can end up with a surprise that you're not aware of because you're so busy running your business. There's a compliance issue that hasn't been considered. So I think it's really important to take that time annually, sit down, look what you're doing, see what compliance obligations you have, and it is more than tax, and where you potentially have risks, and then speak to an expert on how you can mitigate those impacts should one of those risks arise. Where a business owner has a personal guarantee, that carries quite the amount of risk because typically under the corporate structure, you've got the corporate veil, and the shareholder and or director would be protected from debts the company incurs that would otherwise they can't pay if it's an insolvency event. But if you have a personal guarantee on a debt that a business has, and that business becomes insolvent, well, liquidators are appointed, and the bank's going to push those liquidators or receivers to chase you for that money, and they're legally entitled to. So that then makes an issue whereby the person who's provided the personal guarantee, their assets are then subject to being claimed by the creditors, the bank in this case. So you would probably have a situation where you have a personal guarantee. You'd also want to look at what assets are in the name of that individual and protect those assets as well. Ideally, you'd look to get finance for an organisation where a personal guarantee wasn't required. I would recommend only signing personal guarantees as a last resort. Yeah, I would recommend reaching out to your accountant or other consulting expert in regards to protecting your assets and the business structure, because businesses grow and change over time, and you may have set up a structure that was great on day one, but it's no longer appropriate for your current business. You may have put on more employees, you may have bought an additional business, your turnover may be significantly more than it was 4 or 5 years ago when you started your business. So it's worthwhile reaching out to someone like an accountant to find out whether that structure is still appropriate, because you really don't know what it's costing you unless you speak with them. Even more so if you're thinking about transitioning your business, maybe selling or bringing on new business partners, it's a really important trigger to speak to someone to find out what you should put in place before you action that, because often you need a runway of time to implement changes to get the best outcome for that transaction. What we say at Bishop Collins to our clients is you're not alone in business. The reason for that is we have significant expertise across asset protection and tax structuring outcomes. And over a period of time, through what we've done in our expertise, we've provided excellent outcomes to our clients to not only protect their assets, but to minimise the tax implications, not only on an annual basis, but also in a large transaction, whether it would be a business sale or merger, to really get a good outcome for our clients based on our experience over a period of time. In regards to outcomes specifically for clients, we've got a lot of good stories. One in particular, we had a client that was a shareholder in their own business directly. The business was growing. That shareholder was also a director. So what we did was get a valuation and sell those shares from the director who was running the business to a new family trust. What that allowed was to protect the business should the individual shareholder have any litigation or other claims against them. It also provided a good opportunity to restructure in regards to tax and minimise ongoing tax implications, not only each year when the distributions were paid from the business, but also at the end when the business was sold. In regards to asset protection, I'd have to say the key takeaways are turn your attention to it. I know as a business owner, you're busy running your business, dealing with staff, dealing with customers, dealing with compliance issues. However, I would suggest setting aside some time in your diary on an annual basis, half a day, look at your business. If you've got business partners, sit with them. If you've got advisors, accountants like Bishop Collins, invite us in. Just assess the key risks. There may be no actions required off the back of that meeting, but there may be some really important ones, because what you want to get out of that meeting is go, okay, I know what the risks are, I'm aware of them. At least you're informed in making business decisions. And then you're also informed that if this particular risk arises, which I hope it doesn't, but if it does, I'm prepared. I know what action to take straight away, and I know how to deal with it to minimise the impact and mitigate any damage to my business or reputation. Look, to summarise, I would strongly suggest when it comes to risk assessment to be proactive, not reactive.